There she is.
Hey guys, thanks for having me back.
Good to see you. How you been?
I'm doing so good. I think generally we're all just watching in my world is how these equity markets are potentially going to open back up, especially for the big tech giants, which I know we'll talk about, which is where we play. But overall, just also seeing where the Fed's treating these rate hikes and what's going to happen going into the end of the year. So I think just generally life is good. But
Andrea, whoa, hold it. Pump the brakes. We actually like to do at least 5 minutes of bullshit before we get into the thick of it.
I know, you're right.
Don't you remember? Last time we talked to you, you were coming to us from an island like Puerto Rico or something, right?
Yes, and that is actually where I am dialed in from today. I'm based out of San Juan, Puerto Rico, operate one of our offices down here, but I am regularly back and forth to New York as well.
That's outstanding. Very cool. If I remember correctly, you were a dog person, not a cat person?
I'm a dog person, big time dog person. Have two little doodly dogs at home.
Okay. Do you cook?
I do cook, but my partner is absolutely the better cook in this relationship.
Okay. All right, Bobby, do you have any nonsense questions or no?
No, I mean, do you box? I don't want to, sort of box her in from does she cook? He usually asks men. He asks men do you fight, and he asks women if they cook.
Question. That was not a sexist question. I cook. And
I'm
Bobby
kidding.
doesn't cook. I cook. It was an Italian question more than a sexist question.
Actually,
you read it that way, right?
I did.
My father actually said men were always the best cooks, but he only said it to aggravate my mother.
That would aggravate my mother. But anyway, we saw the Fed today. Did you hear what we were saying before you came on? I have this bone to pick with transparency of the Fed. I think it does nobody any good. I think if you listen to the Fed and what they project for their own moves more than a month out is worse than useless because the market thinks it's useful and they tend to be wrong. What are your thoughts on that, Andrea?
I completely agree. I just wish they weren't so coy about every single move, right? I think just generally the market's trying to look out to what's volatility going to look like across all asset classes going into the end of the year. And it just like, can we just get a little bit more visibility, right? And it almost feels as though they don't even know what's going on at this point. And it's just a constant battle of are they making it up along as they go?
Andrea, I think we should get into what you do because, like you said, we're going to talk a lot about big tech, which is where you guys are involved. So give me like 30-second, 30,000 foot view because it's going to be a little different than conversations we have with other people.
Yeah. So where I sit and my team sits. So our firm is called Manhattan Venture Partners. We are humbly a pretty well-known kind of growth and late stage technology investment firm. So, we're investing in companies like SpaceX, Klarna, which is a buy now, pay later, big consumer goods company. And we just actually went through an IPO exit of the first actual tech unicorn company IPO of the year since actually back in December of 22, a company called Instacart, which went public yesterday, which was a big flagship deal. But we're investors there amongst a lot of those kind of flagship names. And what we do is we say, hey, listen, we're going to invest in the flashy big names that have really strong fundamentals. But we always are the guys who we're not going to, be the price maker of those valuations, of those big kind of valuations leading into public company market caps. We're going to be the fund that kind of comes in with that very solid, steady capital behind, some of the bigger crossover investors who play in venture, private equity, hedge fund, asset management. So like you've got the T. Rowe Price, the BlackRocks of the world. And those are the guys that really lead these rounds. We come in, which is a slightly smaller check, and we listen to what we're told to supplement the capital base. But it makes it really exciting because we get a lot of visibility into what's happening in the equity markets because it's just so levered around what the big tech companies are doing. And then obviously leaning into what companies in the FANG and other indexes are doing as well.
So here's my question to you is that so often the market associates low rates with growth just based on those traditional discounted cash flow models that Wall Street uses. Rates have been, wildly high, I would say, compared to, on a relative basis, and tech has still done pretty well. Does that surprise you? And if it doesn't surprise you, why has it done so well in this environment?
I will say, to be honest, Jim, that it's like, I really think that it's not necessarily that tech is is, it's doing well, tech across the board, right? And we could dive deeper into that. I wouldn't say tech is necessarily doing overly well. Tech overall as a sector class has been performing at 15 to 20% of the market highs that it was actually performing in 2021. So it's not like the rebound back to 21 levels is there for tech across the board. And it really is, I think, a testament to these massive rate hikes that we've seen generally. So I think, we want to say that tech can perform well. And of course, you have the Teslas, you have the NVIDIAs, right, that are riding the wave. You have the Elon premium, right, that bakes into some of these businesses. But overall, it's not like tech is nearly at the levels that it was, and we've still got a long way to go, and we could talk about what that looks like from a macro perspective as well. But I will tell you guys, the big thing that happened yesterday, it was wildly apparent. You've got Instacart as the grocery delivery company, right, that's out there competing with Uber and DoorDash and a few others, right? And Instacart is a business that, as a tech company, last raised their big fat round of funding at a $38 billion valuation. And yesterday went out as a public company at a $10 billion market class. So, I mean, if you're talking about where these companies are pricing, it is very much so that there's been a correction. They have strong fundamentals. You've got Instacart with really strong EBITDA and profitability across the board. But overall, it is a testament to say, hey, listen, did some of those big flying tech investors overpay a little bit when the market was good?
So on the Instacart story, real quick, if there's anything you can't say, please don't. But I was glad you mentioned their competition, because when I was looking at it, they were essentially born of the pandemic. I mean, they existed, but they were born of the pandemic. They grew up during the pandemic. And from that perspective, I was trying to think who their competitors were. And the competitors you mentioned, are they real competitors? Because I know that if I need something delivered grocery wise, I go directly to Instacart. I don't even think of the ones you mentioned. So are they really sort of alone in there? Are you being generous by giving those other companies sort of the title of competitor?
Yeah, it's a great question, right? So let's talk about it. You've got Uber, right, is one that I mentioned. You've got DoorDash. And then the elephant in the room, our friendly friend, Jeff Bezos, who's got Amazon Fresh, right? So that's obviously a product under the Amazon domain. Generally, I would say if we're talking about an Instacart competitor, I would say the true comp, right? Because Uber, Amazon have other forms of last mile delivery that fall under their product suite. But when you've got, an apples to apples comparison, it really is DoorDash. And overall, DoorDash is fighting right there alongside Instacart in terms of growth. But here's what I'll tell you, Bobby, is that overall, what Instacart did right was they struck really strategic, exclusive partnerships with various grocers. That means that you're probably thinking of Instacart as the one-stop shop, because they really went to grocers and they signed very long-term exclusive strategic partnerships that bolster the revenue base for Instacart quite substantially.
Yeah, I mean, I'm sorry, Jimmy. I love the story overall because Publix was one of them, right? And down here in Southwest Florida, we have Publix, Jimmy. And the other day I was looking for lunch. I was just extremely busy, and Publix has really good wings. So I went to Instacart. I didn't actually go to DoorDash or any of those. I was just looking for stuff. So the more groceries become sort of an integrated food source where it's not just fresh foods that you have to prepare, it seems to me Instacart becomes a bigger competitor for DoorDash rather than the other way around. I don't even think of DoorDash as groceries. Do you, Jimmy?
No, I don't. And it's funny because that was going to be my question. DoorDash actually is groceries? Please excuse my ignorance. Yes?
They do have, they are not just groceries, so they do have other forms of retail. I will tell you, I just used DoorDash to order up makeup products from Sephora that delivered to my door. So they have a bunch of other kind of retail shops on there. And actually, generally what is interesting is that Instacart just really stuck to the grocery vertical strategically. And I think that's why you guys are probably thinking about them, right? You say, who delivers groceries? And it's absolutely Instacart is the number one market share when it talks about grocer as the form of retail. So that's what they did so well, right? And then they have such a strong revenue base not only because of those strategic partnerships, but they really bolster advertising products within Instacart. So what they did right at Instacart as a business was that they went and hired all of these massive executives, such as the current woman CEO of Instacart, all from Facebook's advertising team. They took all the top folks, they brought them into Instacart, and they said, how do we bolster this as not only a business that has the revenue base from the grocers, but we're going to build in advertising products so the grocers can go in there and compete against each other within the app. But here's what I think is really interesting, you guys, and I'm curious to know your take if you're following it as well. As I look at companies like a DoorDash and Uber, is that what we don't necessarily have here in the United States is that concept of the ultimate super app. The super app being the all-encompassing app. So if you go over to China or if you go to Latin America, right, China has Tencent. Tencent has a bunch of products under the Tencent variety of apps, such as WeChat, where you can order and do anything off of WeChat, send money, do other things. In Latin America, you have Rappi, and Rappi is a company where you can have someone deliver cash from an ATM to your house, for example, and you could do banking products and other forms of things. We don't really have that in the US yet. And I think there's a pretty big land grab to determine who that'll be.
So my Bobby, I know I want to get you in the question too, but so if you're asking me a question, I'll ask back to you. Why do you think then, if we're looking for the one size fits all app, why wouldn't Twitter, just because of its massive user base, Google, obviously, why is Instacart going to win that over the others?
Well, we'll see, right? Instacart may be the ultimate winner. I think just generally, to be honest, I'm not sure whether or not I will see that they kind of expand beyond big box grocery retail as a product vertical and offering. It's potentially going to be it. But overall, I do think I agree with you there, Jim, is that it's probably more likely that we see someone like a Twitter, aka X, right? Obviously the rebrand there. Or someone like an Uber who really tries to take the land grab to be like the one big consumer app. So I really think it's going to be an interesting trend. But here's what I'll say. We here in the US, you guys, right? We know we like segmented products. Look at what's happening in streaming services, right? You've got Netflix and others where, now we're all paying more for our individual streaming services versus that all-encompassing cable box.
From my perspective, I think it has to do with a couple of things. Number one, I don't know how of the two of you, if you also agree with me and my wife, my household here, that Amazon Prime is not as prime as it used to be. I mean, you used to be able to get things same day and next day. And now we ordered this, it's not even important what it was, but it was literally like Amazon Prime should arrive by 3:00 tomorrow. That was 2 weeks ago.
Yeah.
And we still have nothing, to the point where the service has gone down to that level. And the other thing I wanted to add was, of course, Elon has been very public about he wanted X to be this. Now, I just don't know if the Twitter user base is big enough to do that. You would think it would come off of something more like Facebook, which I'm not on, so I wouldn't be able to participate on that. But from that perspective, I think it has to do with, and I'll just use my own example. And Andrea, you could tell me if this is generational or not, because you are decades younger than Jim and I. But I look at Instacart as groceries in the same way, and I look at DoorDash as food, and I look at Uber as a ride. The same way that I don't go to Target and buy grapes. Okay, I don't go to Walmart and buy lettuce. It's just weird to me, and that could be generational. A lot of things, and I talk to my nieces every once in a while. I'm like, why do you guys do this? They're like, it's generational, and they ignore me. So I wonder if that's kind of the same thing. Like, I can get the same products at Target, but I go to Publix. I'll actually take 2 trips rather than go, I can just go get everything at Target. I can go get everything at Walmart or wherever. The other part of it is because of Amazon's underperformance, which I suspect any early stage everything app would have some underperformance. I actually there's things, I'm now one of the few people that will look on Amazon and then will look on Walmart. And half the time Walmart will be a day or two later on promise delivery and 20 to 30% cheaper, in which case I'll order it from Walmart and just wait. Yeah. So I don't know if that's a uniquely American thing or not. It might be just a me thing.
I'll say, overall, I think it might actually be a generational thing now that you say it, right? I actually think the younger generation wants that one-stop stop, the one-stop shop, I should say, the one-stop pit stop. And that's really a big deal to the younger generation is how do they make shopping an efficient, streamlined, all-encompassing experience. I really do. I think from a consumer spend perspective, if you're looking at categorically, like what demographic is coming in to spend at the highest rate right now, obviously you've got the boomers who have like the most discretionary capital. But if you look down, I mean, overall, the folks down in that Gen Z kind of category, they're the ones who are coming in saying they're spending quite a bit for what their age demographic looks like. And they're coming in, I think what I saw, the most recent data from consumer consensus bureaus was like Gen Z is projected to be now the second largest generation of consumer spend after the boomer cycle from what I last saw. So I think overall, if they're the ones kind of screaming for the all-encompassing super app, which clearly is spread across other geographies, I could definitely see a world where you see a land grab for one of these companies, a Facebook and X. I mean, that's very practical to be what happens.
So what you just said there, I think, if I can paraphrase, is that if one is going to emerge, then that one would have incentive to buy a company like Instacart, which would make your investment in Instacart a nice investment. That's what you just said. Am I getting it right?
That would be a really interesting possibility as event. And hey, you're absolutely right. If that hit the nail on the head for what occurred, it would make a lot of sense to get that one kind of, say grocer retail market, which big boxes means big spend, right? Relative to other smaller retail plays. But overall in the venture market, we're just like other VCs. We've got to distribute at the point of the IPO lockup. So, hey, if that were to happen, let's see it happen in the next 6 months following this IPO debut.
That makes sense. So tell me this, your business plan, when you guys decide that Instacart is going to be something you're investing in, do you then have metrics for when you will get out, or do you get in and think that this is a buy for the future, this is something that we like, where it goes, it goes?
Great question. And what's a little interesting about the thesis of our venture fund at Manhattan Venture Partners relative to others, and this is why I love you guys so much, is that we all also have that trader mentality, right? We ourselves not only kind of sit in the role of being a venture principal investor, right? We're deploying capital, but we also operate as a merchant bank. We have our banking licenses under FINRA. So what does that mean? It means that like our investment thesis, which is a little bit unique, is that we're actually not necessarily like going into these big rounds of funding that startups are constantly raising, right? You hear about these high flying ones, and we just talked about Instacart. They last raised a big round of funding at a $38 billion valuation, obviously just now debuted at a $10 billion market cap. So quite a significant discount there. But the way that our venture team operates is that we're actually kind of looking for that entry into the business at a lower price than the that cost basis of the latest capital raise. We're buying kind of stock at a discount by way of our banking division and by way of our visibility into kind of the trading of these private market stocks, which the trading is happening, but it's not happening at the volume that you see obviously in public markets. It's much smaller. But we're looking at an entry price where we can kind of buy into the stock at a discount relative to its mark-to-market valuation of their last round of funding. And what that means is that when we look to exit the business, we predominantly are saying we plan to hold that asset through the exit, right? Through the IPO, and then further, obviously, through the lockup, if there is a lockup in place. But in unique circumstances, right, especially during this really fluctuating period of the pandemic and post-pandemic era, if there offers a compelling exit strategy that we think that our own investor base that backs our fund would agree with, we would definitely be opportunistic, because there's been some pretty interesting opportunities to sell high and then kind of buy in at lower entry prices, or dollar cost average across our portfolio of the venture companies as well.
So if we can go back to markets for a second, and it relates to what you're talking about here. Overall, people have this idea that, and I'm not saying it's a wrong idea, it's out there, that rates go higher, tech suffers. It's just kind of a general thing, right? How real is that? Number one. And then B, notice I went 1B instead of AB or instead of 1-2. I love
Don't know how to do an outline. Yeah.
That's from Mad About You years ago, which you're too young to have watched. So the second thing I would be asking is from a perspective of the rates themselves. We now have the 2-year. I'm looking at it at about 514, between 514, 515. It's 506 this morning. Highest level since I think 2006.
Wow.
Yeah. So that's a long ass time. Is there any reality that's going to sort of punch some of the young entrepreneurs in the face with the cost of funding? And I've said this on numerous shows. It might have been on one of the times you've been on, but Mike Tyson always said that everybody has a plan until you get punched in the face. And I think about some of these 30 something and even 40 something entrepreneurs who were in high school the last time rates were this high. First of all, do rates have that much to do with tech? And second question, which is B, what I said. I'm rambling.
No, it's a phenomenal question. So obviously with rates being as high as they've been, right, over the last few years, overall, and growing obviously steady, and now we obviously are all looking into the rest of the year and what's going to happen. But overall, that means the cost of capital is higher, right? And generally, guys, I think this is what's so interesting to know, right? Because I think, I'm obviously sitting here with this backing of, I'm part of a New York-based firm, but with a really big Silicon Valley base, right? So it definitely emulates the tech industry quite significantly. And what ultimately happened is that the tech companies of the world today that exist all got funded by various forms of capital pools over time. And what ended up happening is those capital pools, venture capitalists, private equity investors, hedge funds, asset managers across the board, they all deployed into these big tech companies and did really well, right? That's the whole premise of venture capital is you raise money with a really high amount of risk, but one winner could return your entire fund. And overall, that means recycling a lot of capital on a pretty steady base. So it means that the actual funds and the allocation of funds from allocators, both in venture capital as well as broader allocators, that just means their ability to diversify or deploy more assets and more capital directly into venture and into tech. Those capital pools have gotten larger. So even though the cost of capital is higher than it's ever been, the actual backers of big tech companies, those pools of capital are bigger, and it means they have to deploy the capital, right? They might not deploy it as quickly, but it is happening. And so for those guys that are acting as entrepreneurs today, it's not as though there is, a minimal dry powder. There's over, I would say, I think I saw most recently, it was like $8 trillion of dry powder across every single allocator venture fund across the board that is sitting there ready to deploy, which is a big, big pool of capital. And so I would say it's not like I would give up hope that you're an entrepreneur and you can't make it in today's world. It just depends on what kind of business you're trying to build. Is it mom and pop? Is it venture? Is it tech? Is it retail? Is it consumer? And then furthermore, I think you guys, I'm sure you could see, but like the ability to launch companies today is just so much easier with the advent of tools to get websites off the ground, mobile apps off the ground. Shopify is like democratized the requirements you need to start an e-commerce business or some sort of shipping business. All of these things are just much more enabled, I think, for the modern day entrepreneur.
So just a quick follow-up to that, because I want, and forgive my ignorance, the pools have gotten bigger, the pools of money you're talking about, by virtue of the success of those companies or by virtue of the higher rates. And the reason I ask about the rates, do companies like MVP, which I just love that, Manhattan Venture Partners, do you have to now judge the possible profitability of a company versus a 5% 2-year?
We do, right? We absolutely do. We have to measure that. I mean, luckily, I said maybe luckily or maybe not so luckily, but for the way we see it is that, obviously I'm looking at where treasuries are, for example, and it's like, okay, are we going to invest in this company? Or are we going to go for treasuries? I mean, as a business, our mandate is we can only invest in private company technology assets. So it's not like I can even look to the public equities and deploy there. But what you're saying, Bobby, is a great question, which is like, for those big capital pools, like I mentioned earlier in the show, which is T. Rowe Price, Fidelity, right, the crossovers, the hedge funds, they're the ones who are kind of measuring twice here in terms of overall deployment and saying, do we go into the private companies with those bigger check sizes? Or do we go into something that is more steady and just the cost of capital there is not so high, and where they can generate real yields on a more steady basis, right? Those are big questions that are being addressed. What I will say is that in the tech market, the traditional hedge fund players that you see that really kind of swooped in and tried to take a seat in tech, you see a lot less of that activity these days. Those hedge funds have really diminished their portfolio size in tech companies. They're the ones that are kind of scrambling a little bit to recalibrate their public equities portfolio across the board. But when it comes to those bigger crossover guys, they are definitely considering whether the rate hikes have led to them having a slower or smaller capital deployment schedule.
So we have talked for 28 minutes and we haven't mentioned AI. If we're talking about tech, did we violate some rule or anything? But anyway, the question is that trade to me seemed relatively played out. The concept certainly not relatively played out. If you remember back the internet, the internet bubble exploded, everything came down, but the internet obviously wasn't going anywhere, and I don't think AI is either. When you look at the way those companies have traded, obviously NVIDIA comes to mind, but there's a host of others as well. Is that trade, is it commensurate with what it should have been, the rally that it had, and how do you want to play it?
So it is fundamentally one of the strongest, most challenging questions to observe in the world of venture capital leading into the public equity markets today. So it's such a great question, and we definitely have to give ourselves all a pat on the back that AI wasn't referenced once in those first 28 minutes. But overall, I was told that if you mention AI in your earnings call, your market cap has to increase by at least 10%. Right off the bat, right? So that's the running sentiment. But overall, yeah, I would say generally everything you said around AI is absolutely accurate. I would say though, what I worry about, and I'm sure you guys are also seeing the same trends, and you guys obviously have more cycles of experience than I do on this, but I worry about that really insane premium being added across a company's base simply by saying they intend to embed AI models, which is in the form of large language models, LLM models right now across the board. The ones that are saying they're going to use some form of AI are phenomenal, but overall, what AI is doing to the market is increasing TAM, right? Increasing the total addressable market to reach consumers and democratize the ability to provide services and respond to questions being asked by consumers by using forms of AI to actually connect with your user base and those consumers. So, I would say generally, I just worry a little bit about the insane premiums going on for AI that remind me a little bit of blockchain a couple years ago, and then obviously many other sectors. But I definitely feel that the market overall can bear substantially more activity, and I don't think the premiums there are going to slow down for the foreseeable future.
Right. So, Bobby, this is to you in case you couldn't hear exactly what she said. When she said you guys have experienced many more cycles than us, it was definitely she's saying that you were old. Plus, is it weird that every time she says that's a great question, I go, yeah, thanks. I mean, is that weird or no? Bob, what do you think?
No, I've been writing down how many times she said I had a good question, how many times she said you had a good question.
It's 2-2, by the way. I have it in my head.
Yeah, but I have outstanding questions. So
you did. I remember that.
I did get one of those. So from reference of tech again, generally, so many people are talking about this being reminiscent of the tech bubble in 2000, right? 1999, 2000. Without naming a sector, do you see any sort of situation at all where we could say, okay, this particular area is going to be reduced by 20, 30, 40%? I think the overall, like in 1999, 2000, when you were 4 and Jimmy and I were like 48, you literally had every single company would just put .com on the end of it. And I feel like that's happening with AI. Like, Chipotle is going to add AI into your food choices or something. I mean, just everywhere you go, somebody's saying we're starting to use AI. Do you see any possibility that sort of a thing could happen again with tech?
Oh, absolutely. Absolutely. And I do just want to say for the record, I thought I said a couple cycles ahead, that you guys were a couple cycles ahead.
You
Just
said
to
a
be clear.
few. I'm going to go to the tape.
Did I say a few?
Yeah.
We'll have to revisit the tape.
Throw up the replay flag.
Exactly. So with that said, I would say I am absolutely worried about the premium baked in, that it is going to see a run up and then experience a pretty significant drop off in terms of market cap, overvaluation, over inflation into the excitement of some of these businesses. And overall, guys, I think here's what's important. What is clearly happening in the world of AI is that Microsoft and Google are putting their stake in the sand and saying that they need to own it, right? They need to own it. And I think that where, if I see it, as I speak to folks who are executives at Google, Microsoft, and some of the other big, massive tech corporations, it's actually Google who feels almost the most slighted in this space, to be clear. And that they were really the guys who were like the advent of artificial intelligence in the forms of how to embed technology to consumer search, and then have that technology interact with the user base. Obviously, Google search is the biggest domain in history. And so if you kind of think about it, I think that what's happening is you have investor capital that is just running capital in such a high velocity into the tech companies that just simply stash that up .ai tag at the end of their name, just like you said, Bobby, at the end of a domain, just like .com. And what's going to happen is you're going to see that I think corporations are going to trust what's being built and deployed out of Microsoft and Google, who are going to have really high ethical, safety, and technology standards relative to a lot of these other guys who are much smaller technology players who are trying to peg themselves as purely AI businesses, who I think those are the ones who are going to see the biggest drop off in valuation, are the smaller guys. Whereas it's just easier for Microsoft, Google, and NVIDIA, who's obviously building the chip technology behind all of it. Those are the ones who are going to benefit the most. And all of the smaller guys with the .ai handle are the ones who are going to be hurt when it comes to the reduction in value.
And that was a spectacular question, right?
Okay. Spectacular. Now it's 3-2.
I'm taking that.
Thank you. Okay. So we're talking about, and I know that you didn't say bubble. You said stretch valuations, and there's a big difference. When you look at this is a question for both of you, I guess, and I'm just kind of musing here. There really can't be a bubble in any other sector of equity markets except for tech, right? There's not going to be, can't be a bubble in utilities or bubble in staples. I mean, it's because a bubble has to be about the future. It has to be about, yes, this doesn't make sense right now, but you just wait. Am I missing something? I guess I'll start with you, Andrea. Yeah.
I would say maybe if you look at FX currencies and otherwise, maybe that there's a world of that depending on what the macro environment's looking like in various geographies, jurisdictions, right? But I almost feel as though, you say bubble, and that could also then potentially lead to bubble per se, but it also could probably be the absolute opposite, right? If you're looking at various currencies across the globe that we have pending doom planned for. So it could be a bubble burst scenario, but I would say otherwise, I would definitely lean towards tech as probably the one sector that you would see otherwise a bubble.
Yeah, I agree with you, Jimmy. I agree 100%. I mean, when people talk about bubbles, they're referring to tech. They used to talk about the bond market. Right. But theoretically, depending on how high you think rates need to go to burst that bubble, it's been burst. So, there might be, it's not here now, but I think the next potential other than tech might be emerging markets. But there's a ways to go before that would actually become a bubble.
That could happen. I could see
it could happen. Yeah. And, I think about it from the perspective of what they're trying to do with fossil fuels in the major economies. And the funniest part about that to me is, where do all our cars go? The average lifespan of a car in the US is 12 years, and then they get shipped off to emerging markets where they continue to be repaired and used. And, as their standard of living increases, they'd like their homes to be heated and their cars to be filled with gas. And they're not
imagine those greedy people who want that.
I know. So I think emerging market could be the next one. But yeah, I think right now you can only refer to tech. So either tech's a bubble or it's not at this point. But I don't even really know what a bubble means.
By the way, you said FX, by the way, and I was just on the podcast with Ninja Traders today. And looking at the yen chart, I think that I'm actually thinking about getting long yen. I'm like a bunch of criteria have to be met, but I could see a scenario where the Bank of Japan starts saying, yeah, we're going to let the band raise a little higher too. And there's a lot of shorts in that yen trade. Can you speak to that at all, Andrea? You mentioned FX first.
Yeah, I would say, I could definitely see that. I do worry about Japan's economy in more of a long tail play. I think that they're, how do I put it? They are struggling right now with the reality of what's going to happen when it comes to overall trading volume across not only their currency side, but on their banking front as well. And what I think, if we're just talking about kind of even further macro there, they're having such a problem when it comes to population control and underpopulation. And furthermore, I think from an economy perspective, they just clearly see their friendly or not so friendly counterparts across the pond in China, and seeing that overall, it's not like those guys are doing as well as they were in the early part of the COVID bubble. And I do worry just generally, if I look at the yen trade, it's like those short positions you just mentioned, that's what I'm kind of keeping an eye on and probably kind of look closer into.
I'm putting up a yen chart right now that I've got in the background, and this is going to be dollar yen, Jimmy. So
okay.
This is the dollar rallying. And this is a weekly. And it's kind of amazing when you look at this chart, how long this has been going on, essentially since January, right? And then you look prior to that, okay? Here's a sell-off that happened last year, but look at prior to that. I mean, the yen has just been devaluing essentially since 2021. It's absolutely nuts to me. And we actually have, the reason I wanted to put this up, and I like both your comments on this, there's starting to be talk with this new regime, Ueda, I believe his name is. I have trouble pronouncing his name.
Ueda is correct. Yes.
Yeah, where he's going to sort of give up this yield curve control. And for some reason, I have the hardest time. And I was actually in the yen pit at the CME for a while, Jimmy, before I went into the Eurodollars. I have the hardest time visualizing a slight give up on yield curve control changing this trend. And I don't know, maybe you guys can help me with that. Like if they give up yield curve control completely, the yen strengthens because the yields go through the roof, but they still don't have the kind of economy that are generating yields like in, well, not even Germany right now, but in the US, or, you look at some of the slightly better inflation numbers we got out of the UK this morning. How does this actually play out if they slowly ease out of yield curve control?
Can I take that first?
Please.
This is so unusual that I disagree with you as much as I do, because I believe if there's so many people are on one side of the boat, oftentimes it's just the straw that changes around and has people head for the exits. And that chart you just had out, if we were to retrace half that move, that is a big trade if we start to move that way. Andrea?
I completely agree. It is fascinating, but it absolutely plays into the economy there, right? It's never been the fastest paced economy, and which is crazy to me to kind of think about it culturally and otherwise. I mean, it is a culture that works 6-day work weeks, right? It's kind of like what's going on there overall, right? So I just think it is, they've got the yield curve concerns that overall could crush it if they don't keep an eye on whether or not they can control the currency.
So I'm not sure if this was cultural or industry specific, but early on in my career, I worked at a very large Japanese brokerage firm, and there was outright segregation between the Americans and the Japanese in the office. We said hello, and I don't know if you remember, Jimmy, we had 2 separate desks on the floor, one on each side of the trading floor, right? And from that perspective, like the guys over there, we would literally go to the office afterwards, and all the Americans are like, okay, market's closed, we're gonna go get a drink. And the Japanese would be like, yeah, you guys go. I remember a couple times forgot my briefcase or my wallet or my head. I just forgot stuff all the time. I went back to the office. They're all drunk reading Japanese comic books. I mean, they weren't working. They were just
No, well, that's always been part of the cultural stereotype too that I knew from the last 40 years, is that yes, they work 75 hours a week, but they don't really concentrate much on efficiency. A lot of it is faced like, I'm here, I'm ready to work. Yeah, that's the case, right?
And I guess my question is that an industry thing? Because I'm talking about them drinking and reading comic books while I was drinking and
they're there at the office
and flirting with waitresses. So it wasn't that different.
There's no question there.
There's no question there
Right,
at all.
yes. Right. Okay. Can we talk a little bit more about broad macro right now? Because it is Fed Day. The Fed told us that they're probably going to raise once more. They said they're going to keep rates high through 2014. When you look at does your investment thesis depend on a couple things? Now, I look at M2 money supply, and I by my thumbnail calculation, I still find that there's about an extra $2 trillion sloshing around in the economy that wouldn't have been there if not for the $7 trillion force fed for COVID stimulus. Do you look closely at things like M2 money supply, at like the Fed's balance sheet? And if you start to see liquidity restrictions in the market, does it make you less aggressive?
Absolutely. Absolutely. It leads to a slower capital deployment schedule for us, right? Because overall, what that'll mean, right, is I'm looking at for us as tech investors is, again, it really leads back to the cost of capital. It's going to say how fast, what are those borrowing costs, right, across these companies who have big fat balance sheets that they're trying to lever and do hedging strategies against. And then furthermore, does that mean that we're going to sit back and say, as we see what's happening at the Fed, the cost of doing business for tech companies, is that going to increase, therefore reducing their balance sheet, their capital, their money supply themselves? And furthermore, what does that mean for us as investors? It will lead to better buying powder, better entry and valuation possibilities for these companies in tech that otherwise, like we said, in 2021, we're really hitting very large peaks. I mean, you guys, if we're talking about this right now, okay, the tech companies in Silicon Valley, and you might just sit in your seat, you might just faint with this information. If I, as a tech investor in 2021 was looking at a deal, okay, traditional, maybe enterprise software company, just straight line, right? Overall, there was a world where I was looking at a company valued at 100 times forward revenue as an affordable deal.
Wow.
Okay. And it depends, right? The whole thing with startups and tech companies is that they are supposed to grow at effectively a 100 times faster clip than their public company comparables. And as we look into these businesses today and the public company comps, okay, those public company comps on average, if we're just looking at enterprise software, which is the highest traded vertical within tech, those companies are trading at 7 times next year's revenue, or let's call it 10 to 12 times this year's revenue. And like I said, what I was looking at during the COVID peak was 100 times forward revenue as something that was potentially an affordable deal. And that's where tech companies were getting valued.
So you say, in a word, you're saying that the current market right now is sane by comparison to some of our historical standards, right?
Absolutely.
Robert?
I keep looking up at my screen here and I see statements from Powell that soft landing is not our base case, but we expect a soft landing. I'm paraphrasing a lot of this. We are prepared to do another rate hike, but we don't think we will need to. Jobs have softened, but they're still strong. I mean, it's like one of the most confusing Feds. Well, they've all been confusing.
And Andrea, the Fed, let's have just AI be the Fed. This is stupid.
Yeah,
these guys don't know their ass from their elbow, and they seem like hell of a nice guys, and I think they're working hard. It's just an impossible thing. I don't know if you saw the thing I tweeted today, Bobby. Asking Fed policy to fix the economy is like saying a quarterback's got to lead his receiver to a spot he's going to be in 6 to 9 months. It just seems like an impossible throw. Correct? Am I wrong on this?
Yeah, I mean, it's like saying, I love pizza, but I don't like to eat it.
Yeah.
Right. Or I love you, but I'm not in love with you, Jimmy.
No, I do love pizza and I don't eat it because of the gluten. But so I understand the dichotomy.
Yeah. It's so true. And I mean, I'm sure you guys have discussed this nonstop, but it just also something we discussed in the last show and something I think carries into today is it's also clear that the evolving definition of a recession is clearly completely up in the air. We don't know what the leading and lagging indicators really are. Yeah. And I just think that we need to recategorize expectations. And what you said, Bobby, around a soft landing, it's like, of course, everyone wants a soft landing, but where are we really?
Right.
And by the way, the concept of soft landing too. I always think about that joke about the guy jumping off the 40th floor, and as he's passing the 20th floor, saying, so far so good. Like, it doesn't always seem like a soft landing as the plane's going down until it actually makes contact with the ground. Again, I meant that metaphorically. I really believe that it always appears to be a soft landing until something breaks. Correct?
Absolutely. Exactly. So, and we're kind of assessing, what is that asset class going to be? That is the straw that breaks the camel's back in this next period of volatility, and going into obviously holiday season, which clearly sees lower trading volume across the equities markets, which then leads to reduction in overall value. So I think generally we're going to be kind of looking towards, I think, holiday season is the consumer spend. What's the seasonality of businesses and buying powder going into early 24? And, what does the consumer reflection on that look like as businesses are obviously just battling with inflation across the board and trying to get retail spend to come up? I think that's where I'm just kind of trending, and that's going to have a massive trickle down across every industry.
So I don't know if you guys know this, but in the last hour, I mostly broker SOFR options, 3-month interest rates and Fed funds, but there were some massive upside plays, meaning for lower rates, short end rates. Like, someone took down 100,000 Fed funds futures contracts post Fed today. I don't know what, and again, in the past, when we've seen trades like that, it almost seems like someone, not knows something, you know what I mean? That something then comes and happens relatively quickly. So if something is going to break, last March we saw the mini banking crisis that seemed to be stemmed pretty quickly. What does something breaking even look like? 5% unemployment? What do you think, Andrea?
5% unemployment. I think overall, I'm looking at. I think my biggest concern overall is still the stimulated inflation rates across the board. For us, I think it's, like I said, I actually also do worry about consumer spend. I don't know. I think, as treasuries continue being strong, that to me is always a safe consideration. I hope, I'll tell you guys, I get continuously called a hope junkie because I'm a venture capitalist, which is amazing. So there's this constant stigma of being overly positive and bullish across the board, not necessarily a good thing, but I think overall, I'm not necessarily sure I see as that one asset class or that one thing that's going to be the camel right now.
I think it's commercial real estate.
Interesting.
I think that could be. I'm actually working on putting something up here, and I'm not really going to speak to it. I'm just going to put it up here as a, just something to look at and kind of take in.
So then you think what you're saying, to put a finer point on what you're saying, is that the companies that are huge owners of commercial real estate will all of a sudden be potentially throwing in the towel and going into bankruptcy, correct?
Yeah, I'm not sure what I think of it, to be honest. I'm just to answer fairly. And I'm rambling because I'm trying to put this thing up here.
But Bobby, I definitely agree with you, actually, that, you have the right answer. That's what I'd align with: commercial real estate, not residential real estate. Absolutely commercial real estate.
Yeah. So here I'm putting up this chart of subspace lease accounts with negative demand. Now, I probably shouldn't share this because I'm not even sure if I'm supposed to be sharing this, but it was given to me by a friend. And you just look at where the sort of negative demand has been since the pandemic, and it has not gotten better, right? And a lot of this has to do with work. I think I can zoom in it a bit, Andrea, because it is very, very weirdly cropped. Let's see if I can make this bigger.
Yeah.
Is this getting bigger?
It's getting bigger.
Too big?
No, it's good.
Good.
Sublease,
Yeah.
sublease. Okay. Yeah.
This, and that was Q2, right? And the person who sent me this said, just so you know, it's gotten worse from a perspective of commercial real estate. And this is in a very large city. And I think we should take this off the screen because I'm not even sure if I'm supposed to show it. But I did it anyway, and I will accept the responsibility for that. But I guess from that perspective, something breaking, that to me, not residential. It seems to me to be the most likely is going to be commercial real estate. And it could break in a big way. It could be more bank failures. It could be some of these large owners of commercial real estate can't find someone to bail them out. And my buddy is in the business of bailing some of these banks and owners of these buildings out.
Yeah.
So, and he's been,
Yes.
he goes, I've been doing a lot of business. He goes, I'm either going to be the richest guy you know, or I wonder if you can kind of have me to mop your floors once a week so I can pay my bills. It's going to be one or the other for him.
I think it's super important to be looking at these lease durations on the commercial bank on the commercial real estate buildings overall, and how long they're going towards. As you saw that sublease data, that's absolutely fascinating. I think it's clear, guys. No matter what we say, some of the major corporations with absolute leverage are the ones calling their employees back. But I think generally, with the advent of just online jobs across the board, it's a massive reduction in OpEx to have your employee base work remotely, right? So I think just the requirement to be in office at such a consistent basis is really still going to remain concentrated across, like I said, the big corporations who have leverage to force their employees to be there. But overall, it's clear you just don't need an office to operate a business these days. And so I think you're absolutely right. But I will challenge it with this, which is I would also then kind of dig in, if you're looking at filings, is who are the underlying owners of all the commercial real estate buildings? And overall, if that's still outside overseas international capital coming in, those are the guys who are still saying parking their capital base within the United States into these commercial properties is still a better bet than whatever their local jurisdiction is.
That's really interesting. So we got about 6 minutes left. So my last question of any substance, I should say, is how does somebody get you to look at their company? Is it the people? Is it the business? Is it the math? And if it's a combination of the three, which I assume it is, what's the weighting?
Oh, what an interesting question.
Interesting is not good. Do not write that down.
I'm putting it down. It goes in my column.
Don't worry, Jimmy. We can have your turn too if you want to throw.
Ask another one. You guys, that's fabulous. Go on.
But no, overall, see, guys, like for me, I'm absolutely like, I'm that type of investor where they have to already have a pretty proven, sustainable business. I mean, we really start looking at companies once they've hit about $100 million in annual revenue. So pretty up there, right? They're like 2 to 3 years away from their formal exit. So it's typically, like I said, a pretty brand name business. But overall, I am looking at them growing. Here's what I'll tell you, just fundamentally, it still has to be a business to me that's growing typically 50% year over year or greater. I still have to see that. And if you're looking at public companies, right? If you're looking at public companies across the board, depending on the sector, those companies are growing 20 to 30%, on range. I mean, that's a pretty broad base year over year. But the private tech companies that I have to look at, I'm still looking at some pretty healthy growth, which means, you guys, that it is still commonplace, if you would believe it, that lack of profitability is still something we kind of want to see, because I don't want them to be profitable. I want them to be growing. So it actually still raises an alarm, even in today's environment, that if I see positive EBITDA margins, I'm like, wait a second, tech company, slow your roll. Let's invest more in growth. I need you to beat your public company comparable at Google or Microsoft, and let's put some fuel on that fire. So even though the market reset has very much so been in swing across public equities and tech companies, I still need to see these companies at a pretty high growth clip.
That's super.
So,
I would have never thought that was the
me
case.
neither.
That's awesome.
And that's, by the way, that is fascinating to me.
Yeah, it really is.
That's worth
really
it
is.
just for hearing that. I think that's really cool. Do you ever invest in companies that are already public? The answer to that is no, right?
No.
Right. Okay. So then the next question is how many? Oh, go. Yeah.
But Jimmy, this is what makes that question absolutely incredible is.
Thank you. Incredible. There's been one incredible, Robert.
That incredible kind of beats all the other ones.
Okay. Good.
What you just said, though, is key. So the one exception to that is obviously the big one, the big elephant beast in the room is Twitter. So Twitter was a public company. Elon and the take private deal, that is one of the hottest tech companies that we've seen in private markets. So we invested there when Elon took it private. Overall, we have obviously a lot of promise. And so that Elon premium is very real. So even though that was an untraditional investment for us, that was something that was super exciting.
Well, that's actually really interesting. And by the way, the branding, X, I think that's dumb branding. Like, who's the ad agency that's coming up with that? Do you guys agree? It seems stupid.
It is absolutely Elon's desire to become the super app and become like the end all be all. And isn't it that he named his child something like that as well?
Yeah, he
I
did.
don't know.
He did. I gotta stay. And I mean, I guess I'm a douchebag. I like it. I wear black. I have tattoos. I like things like that. It's just a black X. I wish that were my name, to be honest.
All right. Okay. Let's wrap it up. Do you have anything else interesting? Yeah. Are you done working today, Andrea? You got to stay around the office more.
Oh, I've got to stick around here. I do so much business with the West Coast and Asia, so I will be up dealing with the markets over there as they start to wake up.
Oh,
Well, here's
fantastic.
hoping
Good.
you get past this hurricane season as much as I hope we do.
All right. One last thing I'd like to say is that, again, the people who watch either of our podcasts, Traders Edge, Futures Edge, you can think Bobby and I are both bullshit, but it is undeniable that we get outstanding guests. I don't know what that meant. Maybe both of us have been in media for 20 years and we made some good connections, but thank you so much for being here. I could listen to you talk for 2 hours, but I got to get home pretty soon. Thank you so much, Andrea.
Of course, guys. Jimmy, Bobby, you guys are incredible. Thanks for all the questions and all the fun. I can't wait to talk to you again.
Good to see you, Andrea.